Howdy, everybody. Welcome to Liberty Call. Today is Wednesday, June 11, 2025. Hope you're having a fantastical day out there in the interwebs. You can see my main man, Nolan, back here sniffing all over the ground. Let's hope he doesn't do anything he shouldn't. So anyways, hope you're having a fantastical day. It is gorgeous here in Colorado. We had a little bit of a thunderstorm pass over, but weather is nice. I can't complain. All right, markets hit pause today as Wall Street digested tame inflation data and fresh U.S.-China tariff framework. The Dow eked out no, didn't they? It was about to eke out a gain, while the S&P and Nasdaq slipped slightly. The CPI came in cooler than expected at 2.4%, stoking talk of Fed rate cuts again. But with trade uncertainty still looming, investors aren't celebrating just yet. So before we break down all the news for today, I need some help from you. If you could do me a favor, give me some thumbs up, a like, share, subscribe, or follow. Press the notification bell. All right, let's get into today's markets. Dow Jones flat at 0, was down 1 point, closed at 42,865. S&P 500 down 0.23%, 14 points, closed at 6024. Nasdaq down 0.5%, 99 points, closed at 19,615. The VIX was up 1.83% today. It's at 1726. Canada up 0.37, Brazil up 0.55, and Mexico down 0.57. In Europe, Germany was down 0.05%, the UK up 0.13, France down 0.36, the Netherlands down 0.33, Spain down 0.61, Italy down 0.07, Switzerland down 0.11, and Portugal down 0.21. Russian exchanges were mixed today. The MOEX up 0.41, RTSI down 1/10. And the overnight markets, the Nikkei in Japan was up 0.55, Australia up 0.06, New Zealand down 0.42. In China, the Shanghai up 0.52, Shenzhen Component up 0.83, China A50 up 0.84, DJ Shanghai up 0.55, Hang Seng up 0.84, and the Taiwan weighted when it closed yesterday was up 2.07%. Those are the markets. Very exciting stuff, I know. All righty, well, let's get to the market recap for today. S&P 500 struggles for direction amid slowing inflation and trail deal confirmation. The S&P 500 seesawed Wednesday as slowing inflation raised hopes for Federal Reserve rate cuts, while President Donald Trump declared a long-awaited trade deal with China, quote, done. Trump stated on Truth Social that the agreement, pending final approval from himself and President Xi, will grant the U.S. access to China rare earth minerals and magnets, while Chinese students may continue studying at U.S. institutions. Well, there's a genius idea. However, the U.S. will retain a 55% tariff on Chinese goods, while China will impose a 10% on U.S. imports. Markets remain cautious due to the lack of specifics and the failure of past deals like the Geneva Agreement. Adding to global unease, the U.S. announced partial evacuations of diplomatic personnel from Iraq and other Middle East outposts, citing security concerns. This comes amid renewed threats to strike Iran if nuclear talks collapse. I think that's a gigantic mistake. The United States has no business telling Iran what they can do within their own borders. As long as they don't attack anyone else, and I know Israel is always, Iran's going to attack any day now. They're minutes away from having nuclear whatever. I've been hearing that since the 90s, so I wouldn't put a lot of stock in it. A lot of it's just saber rattling and wanting more arms from the U.S. So, all right. Meanwhile, U.S. inflation data provided some relief. May's consumer price index rose 2.4% annually, below expectations, and only a 10th monthly. Core CPI, excluding food and energy, remained steady at 2.8 year over year, with a 0.1% monthly increase. Rate cut expectations for September surged to 70%, up from 57%. On the earnings front, Chewy beat sales estimates, but missed on income, dragging shares lower. Victoria's Secret topped earnings forecast and reaffirmed guidance despite trimming profit expectations. Investors are eyeing Oracle's post-market report with attention on its AI-driven cloud growth and projected cash flow. Wall Street expects $3 billion in free cash flow against a $3.8 billion in capital spending. Oracle's AI push remains a core part of its growth narrative amid broader market uncertainty. Okay. Alrighty, so that is what's going on in the markets today. Let's dive into some data. The May CPI report from First Trust, Mr. Nate Guernsey put it together. So let's see what he had to say. Inflation data for May came in cooler than expected for the fourth consecutive month, rising just 0.1%, reinforcing skepticism about the inflationary impact of tariffs. Again, I've said that tariffs will have no impact. While tariffs may raise prices on specific goods, they tend to reduce spending power elsewhere, effectively shifting, not expanding, inflation pressures. Analysts argue that monetary supply plays a far larger role, and with M2 flat since April of 22, current monetary conditions remain tight. This tightness has likely continued to contributed to inflation rising at only 1% annualized rate over the last 3 months. Breaking down the data, food prices rose 0.3%, energy prices fell 1%, and gasoline declined by 2.6%. Core inflation, excluding food and energy, increased just 0.1% in May, well below the consensus estimate of 0.3%. Core inflation is now up 2.8% year over year, but has slowed to a 1.7% annualized rate over the past quarter. Prices in tariff-sensitive sectors like apparel are down 0.4%, and new vehicles down 0.3%, continue to drop. Notably, supercore inflation, a measure excluding food, energy, and other goods and housing rents, has also cooled significantly. Once closely followed by Fed Chair Jerome Powell, this metric rose just a tenth annualized pace in the past 3 months, down from a 4.1% year-over-year increase in January to 2.8% in May. Key supercore declines included airfares down 2.7% and hotels down a tenth. Although inflation remains above the Fed's 2% target, the recent softening combined with subdued money supply growth suggests it may be time for the Federal Reserve to consider modest rate cuts in the coming months. I don't agree on that part. I think we should just leave interest rates where they're at or let the banks decide what the price of money is, not the Fed. Anyways. All right. Got another article here from investing.com. Federal budget balance dips lower than expected, indicating a deficit. Shocking, I know. Our government spends more than they're bringing in. The U.S. federal budget balance for the latest reporting period revealed a significant deficit of $316 billion, exceeding the forecasted $314.3. Wow, it's $2 billion over they wrote an article about it, and sharply contrasting with the previous $258 billion surplus. This metric reflects the gap between government revenue and spending, with a negative figure indicating a deficit. The transition from surplus to deficit marks a notable shift in the government's financial standing. A higher than expected deficit generally implies increased government borrowing, which may exert downward pressure on the U.S. dollar, while markets sometimes interpret a smaller than a forecasted deficit as positive. In this case, the actual result was worse than projected, potentially leading to bearish sentiment for the dollar. This swing also underscores rising fiscal pressures. A surplus means the government is bringing in more than it spends, while a deficit signals the opposite. The fact that such a wide gap has emerged, especially when compared to the prior surplus, could raise concerns among investors about long-term debt sustainability and fiscal discipline. Overall, the report signals a deterioration in federal finances, which may include or influence bond markets, monetary policy decisions, and currency valuations in the months ahead. Market participants will be monitoring future budget reports for future trends. So, again, it's not really shocking that the government overspent. So, alrighty. Let's get to our last article here from Zero Hedge. U.S. collected a record $22 billion in tariffs in May, which was just 3% of total government spending. So multiply that by 12, it comes out to 36%. So about a third of government spending. All right. In May, the U.S. government collected record $22.2 billion in tariff revenue, driven by President Trump's aggressive trade policies, more than triple the highest monthly tariff intake from his first term. That's the good news. The bad news, this record sum covered just 3% of the month's total government spending, which hit $687.2 billion, up 2.5% year over year. While total tax receipts rose 15% from the prior year to $371.2 billion, thanks in part to a tariff surge, federal spending has consistently outpaced revenue. The result was a May deficit of $316 billion, slightly worse than expected, though marginally better than the $347 billion shortfall from a year ago. The cumulative fiscal 2025 deficit now stands at $1.365 trillion, surpassing 2024's 1.202 trillion and higher than any year on record outside of the pandemic anomalies in 2020 and 21. Despite strong April revenues, the long-term trend remains bleak, especially with interest payments totaling $92.2 billion in May alone, on track for a staggering $1.2 trillion annually, nearing Social Security's massive outlays. Even with Trump's fiscal tightening efforts, all major spending categories are growing faster than revenue. Without structural reform, the U.S. faces an unsustainable fiscal path, and any attempt to rein in spending faces fierce political resistance. Well, of course, it would face resistance, because if you can't rob the people, they have no way to launder it back to themselves. So, yeah. Anyways, all righty. Well, that is everything that I had to ramble about today. So if anyone wants to get in touch with me, wants to get their financial plans back in order, where do you want to go? Doodle-doo-doo-doo, DSAFinancialGroup.com. All your financial planning needs can be addressed there, so give me a call. I would be glad to help. Hope everyone out there has a wonderful evening, and I'll talk to everyone again next time. Adios.